In this session we're going to talk about the accounting equation. We'll see at the end that it's quite a simple relationship, and even the most sophisticated accounts are built up from these principles. So I want to take you through a scenario, a pretend scenario, and we will look at the way the accountant's equation comes into play. So we'll start with a scenario, and the scenario will be that Jim, whoever Jim is, Jim has just opened a business called Right Car, a local magazine advertising cars for sale in the local area. So that's Jim's business. Jim has a small car magazine advertising local cars in the local areas. People want to buy second-hand cars and sell their car and so on. Now, in order to do this, the following transactions were needed during the first days of trading. So in order to get the business running, he had to incur some costs, and he needed to record these costs. Now, in a test situation, a student test situation, you may be required to draw up the accounts or the accounting equation at the end of each day. And that's what we'll do here. First of all, we'll look at the scenario facing Jim, what he did, and then we'll construct the accounts. So we start with the first day. Let's say the first day was the 20th of November. Now, Jim opened a bank account and deposited £10,000. So that's the start, £10,000 into the business. Days 2 to 5, Jim needed an electrician to provide power to his new office. So he paid the electrician £4,200 on the 30th of November. So he put £10,000 into the bank. Now he's paid out £4,200 on the 30th of November. Just perhaps keep a short note on each of these, so that when we're working through the accounts in a moment, each one will be fresh in your mind. Right, now on day 6, Jim decided to stock some small car components and advertised them in the magazine also. He managed to negotiate credit on the stock of components. He needed to pay for this stock on the 21st of December, and this amounted to £27,250. So now he's going to sell some small items associated with cars in the magazine, and he paid £27,250, but he got it on credit. He doesn't have to pay it until the 21st of December. Later on the 7th day, Jim realized that more cash may be needed to run the business. So he arranged a business loan from the bank for the sum of £45,000. Now, that's what we've got. Okay, so we've got, he opens the business on the 20th of November, £10,000 in the bank. Then he employed an electrician, £4,200 on the 30th of November. Then he managed to get some stock which he would sell in the magazine, and he owed £27,250 for that, which he had to pay on the 21st of December. And then finally he arranged a loan from the bank of £45,000. So let's see how this would work out in terms of a very simple structure. So we start with assets, liabilities and capital. Now, as far as we're concerned here, I'll just put the cursor onto the screen. Here we go. Jim puts £10,000 into the bank, and the capital is £10,000. So the two sides balance, if you like. We've got £10,000 in assets and £10,000 in capital. So that's fairly straightforward. I think that is straightforward. Now next, if you remember, he got an electrician to do some work, and he paid £4,200. So that means his bank account has now gone down, but he has got improvements to the premises, an extra £4,200. So that really is an asset. This work done was good. It helps him to run the business. It's an asset of the business. So his assets remain the same, £10,000. He's got improved electricity, but his bank balance has gone down. The capital has remained the same, £10,000 on each side. Next we've got this £27,000, which is his stock, his inventory. But he needs to pay for that, so you've got a liability as well. So now if we look at it, we've got assets here, £5,000 in the bank, 4,200 for the electrical work, which improves the premises, and he's got 27,250, which he got on credit for these components he's going to sell in the magazine. If you add it all up, it comes to 37,250. Well, he needs to pay the 27,250 over here, so it's a liability. But of course he still has the capital. Well, this is what he put in at the start. He doesn't have it, because what he has is £5,800 really, what he can get his hands on. This is actually in components to be sold, and that's now a part of the premises. But if you look at it, if you add the capital to the liabilities, you get the assets. That's important. That's the equation. Capital plus liabilities equals assets. Simple. That's what you need to know. You need to know capital plus liabilities equal assets. He managed to get a loan of £45,000. If we add in the loan, because he has to repay it, it's a liability, if we add in the £45,000, of course we'd add it on to the bank here. He had 45,000, he had 5,800 in the bank, add 5,800 to 45,000, 50,800. So his assets now are 82,250, but his liabilities are 72,250. But again, capital plus liabilities equals assets. So we've established our accounting equation. Capital plus liabilities equals assets. That is the situation in terms of a balance sheet. And again, if you look at capital plus liabilities, if you add up the liabilities here, they're in brackets because they're owed. This is not the money of the business. Whenever, it's like a minus sign. Whenever the company owes money, we put it in brackets. That's a negative. 27,250 plus 45,000, which is 72,250. And if we add 4,200 to 78,050, we get 82,250. So the 72,250 from those two plus 10 gives you the 82,000 in terms of assets. That's all there is to the accountancy equation. Thank you for watching.